academia and startups to create socio-economic impact. He has 23 plus years of experience in strategy consulting and program management. Now, I would like to welcome Dhruvil Sangvi. CEO of Loginex comes with 12 plus years of expertise in enterprise software, entrepreneurship, and global SaaS products. Been featured in Forbes 30 under 30 and Entrepreneur 35 under 35, and early stage venture investor as well, in companies like Inc. 42 Media, SpendFlow, Urban Yogi, etc. Our fourth panelist we have today is Eklavya Gupta. Eklavya Gupta is the co-founder at Refer Club. He's an investor turned entrepreneur with a passion for democratizing financing for recurring revenue companies. Comes with 10 plus years of enriching experience in capital markets, structured credit, and private equity. He will just join us shortly. So let me begin. And I've been super excited to host you all. So, all right, gentlemen, the first question to Amit sir, you. What advice would you give to startup founders weathering the current climate, the funding winter?
I think the word that comes to mind is survive. Nothing in the world is permanent. This too shall pass. If you are focused on what you're building, just focus doubly just on that core one metric. Do not try to get distracted with doing 10 things at the same time. Really focus your resources into solving that one key problem that will make your business. So the need of the hour is focus. The need of the hour is belief. Running a startup has never been easy. It's always been a tough ask. Last maybe decade or made look like startups are easy and are in vogue, but startups have always been the toughest choice for any entrepreneur. So if you are a startup, you know that you're fighting against the odds. You know that only one or two of the 10 companies that are starting out will actually make it big. You know what you're signing up for. Do not get swayed by what happened in the last decade where money was available in plenty. You be truthful to what your purpose is, focus on what you're trying to build, and eventually fruits of labor will be seen, right? So just keep the faith, keep the commitment, and focus on what you're trying to do.
So you've been seeing this since many decades, I believe, and you've helped so many startups, help them, advise them. What does this really mean for a startup founder? While we are saying that, Bangalore is the Silicon Valley of India, Chennai is the SaaS capital of India, all of us together here as a founder or as an ecosystem enabler or as an investor or a VC fund, we are all here to create an ecosystem for a founder to thrive, to make it a little easy. Like at least it's easier. I'm a wife of a founder, and I know that it was really hard when he started out in 2009. And there was nobody to go to, etc. But today, when we have a system in place, so what does it really mean? The times are hard. What does it really mean? Is it true that the term sheets are being pulled back?
Well, the thing is, it's a new dawn, right? So whatever was the playbook for the last 15 odd years, that playbook has been thrown out of the window. Right. So pretty much everybody has been talking about there being a bubble for about 10 years now. That bubble, whether it has gotten picked or not, is certainly taken a pause for sure. The term sheet getting pulled has always been perhaps the thing that has been talked about, but seldom practiced. You may hear more of that because there is buyer's remorse. Some of the assumptions that people had made, which was completely based on growth, may no longer be true because as companies pull back, as new rounds start getting more difficult, companies will have to reset their projections. If they reset their projections, obviously the growth assumptions that people had made to justify the valuation they were paying may no longer hold true. So there may be buyer's remorse in some VCs feeling that they've overpaid and perhaps their model doesn't work anymore and the investment may not be as attractive. So there could be some cases where those discussions are happening. In extreme cases, you might see the term sheets getting pulled, but a lot of cases you'll see that the company and the new investor will come to an acceptable thing about, okay, in the new reality, in the new growth paradigm, in this new climate, what is my growth plan going to look like? What is my ramp going to look like? And on that, with the new chart of what the growth looks like, you may arrive at a different valuation than what was earlier thought was appropriate. So that reset may result in some renegotiations on the pricing. I do not think that the term sheets pulling out is going to be a widespread phenomenon. It may happen with a few, but longer term investors who spend decades building their reputation do not want such blips to affect their long term commitment to the cause, because once you are branded as an investor who is iffy and doesn't really do his work before committing, and then after that has buyer's remorse, that reputation will be bad for that investor, and he would certainly want to avoid it if he's a long term player in the market. So only extreme situations you might actually hear about term sheets getting pulled. But yes, you do expect harder negotiations because your growth plan may not be as rosy as what you had thought when you presented the case to the investor at the beginning. Because of that change, it may reset the valuation of the company. You also have to sign up for a much more detailed due diligence, which might have been lax over the last decade or so, where people may not have spent that much time reviewing the revenue recognition policies or the receivable situation of companies or some of the contracts. They may not have been so diligent about that. But I think in this climate, the investors are going to be a lot more careful about that. Will really look at the DD reports a lot more closely. And in case there are discrepancies in terms of interpretation, that the MI has stated one thing, but the diligence report is pointing to another, that may again lead to a conversation between the investor and the prospective company. So expect those things. Be truthful, be clear, be transparent. Do not bring negative surprises to an investor discussion. If you're transparent and you avoid negative surprises, in more cases than not, you will see that the investors are on your side.
Got it. Thank you. Dhruv, what is your perspective as you've been building Loginex, SaaS company, advising to a lot of SaaS companies? So you have insights on what's happening, what's in the mind of various SaaS founders. What is your perspective as an angel investor, as well as a SaaS founder, as well as someone who has insight into like what does it mean?
Sure, absolutely. I think as a founder, you do get distracted by a lot of information that comes your way in these times. And I've seen 2 cycles so far. Not that I've seen a lot of cycles in my career, but at least I've seen 2. And then this is the second one where I've come to a realization where, as Amit said, this noise comes and goes. But while the noise stays, it comes from multiple directions, sometimes including your own investors. And the noise usually is not a random chatter, but it is more of a advice or a caution that everybody wants to give you about cost cutting, about being more sustainable, increasing your runway and things like that. This is something I've heard from a lot of founders recently, where they're all trying to suddenly increase their runway. I think one thing that I definitely feel strongly about is that if your business inherently is capital efficient, then there is no need to really recorrect yourself, because then you are already going on the right path. Sometimes trying to recorrect just because of the market environment may end up making you take some steps which may not be fruitful for your business while you're actually doing the right thing. So I think while making sure that the caution is taken seriously, not taking too many steps to become overly conservative is also something that I would say. And I think ultimately everybody has to, every founder should have a strong focus on unit economics, how capital efficient their business is, what are the gross margins, simple things, right? Especially in SaaS, the world I come from. I always say this, that it would take, a lot of stupidity to have a non-capital efficient SaaS business, right? They're inherently capital efficient. So if you're running a SaaS company and if you have high gross margins, you have good recurring revenue, you're already doing well. Maybe try to accelerate further on your collections. Maybe try to focus more on your revenue growth, how to make it more, optimized revenue growth versus trying to cut cost. So like just before this session, we were talking about, and Eklavya was sharing his views that we have recently seen kind of a GA to revenue ratio also being optimized. Now that's something I would recommend avoiding, because that's not a long-term investment you're making of your time. You would rather optimize CAC a little bit if you have to, but if these things are in check, there's no worry that a good founder or a good company should have. And from an investor perspective also, I've seen that I've always seen that strong founders and smart founders already know this game. So they are the ones who are not getting distracted by this noise or by market ups and downs. They are staying focused on what they are building, and they know what the value of their business is. They were never demanding too high of a value, and that's why there is no need to correct. The need I see in correction are for the companies which have sometimes zero or negative economics, right? Where they're losing more money on every single transaction they are making. That means if the more you grow, the more money you lose. And if you do that too fast in next 12 months, you may not be able to raise your next round, at even higher valuation. That could be a challenge. So that's kind of businesses have to, look inside them and course correct. Second is, companies who have kind of raised money at a very high valuation, right? So look at your ideal revenue to valuation multiple, right? Especially if you are mid stage to early stage. If you have raised money at a super high valuation, like valuation multiple or revenue multiple, then there are very high chances that your next round may not happen at that multiple. So even if you have grown, let's say, like for example, I've seen a lot of companies raising at like between 50x to 100x of the revenue multiple in last 12 to 18 months. Now, those sort of multiples are never going to come back, most likely. And they should never come back because they are always unsustainable and they always put pressure onto the market on everybody else again. And so those sort of companies, founders who have raised, have been lucky or have been fortunate enough to kind of raise at that multiple, they should take that capital, preserve it as much as they can, because even if they grow 2x year on year or more than that, they are still kind of chasing their last round valuation. They're still justifying that. So I think having that sense is very, very important. There's something I would say from the investor perspective.
Just to add to what
Thank you.
I think one thing that I would say is that the thing about capital allocation in which the investors were doing, I think the startups have to start doing that themselves as well, right? Because when you have too much money, you start chasing too many things. You have to focus on as to what is that one thing or two things that will really matter to your business rather than chasing vanity projects. So I think in a tougher environment when funding is scarce, it all boils down to your capital allocation, how you manage your resources. They are limited. You recognize their limitations and focus on the one that will help you succeed. Different stages of companies will have to, early stage companies will not have that luxury to capital. So they're forced to think much more shorter term in terms of just surviving and making sure that they're able to still grow, right? Because VCs are still an alpha business. You are looking to invest in the risky asset class of VC only because of the alpha or the growth that sector can provide. So just meandering along, surviving will not really make you attractive. So you'll have to still figure out where you can grow, show that, okay, what you're building has a large market to address. But given that you do not have too many resources, you really have to focus on those one or two things that will show the growth in the market opportunity that you guys are trying to pursue. So it's all about capital allocation. Investors have been doing that for a while. It's time that the startups also just put a lot more focus on capital allocation themselves.
And I think this is where Amit rightly said, right? And this is where I think some of the things like following plays a role, right? How seasoned and experienced the founder is, right? Usually second down founders, they know that they would not typically get excited after raising money and try to open too many projects too soon, right? Second would be how much of an general control or founder market fit that is there. For example, usually I've seen that more B2B founders are usually more attracted towards the revenue piece versus the B2C founders who have more attraction towards the user piece, right? So how do you kind of not go too much into a revenue and profitability direction? At the same time, you don't go too much carried away into a monthly active user and just kind of a user acquisition story, right? So having that founder market fit also kind of shows up in these times. Where how good of a match you are as a CEO with the sector that you are in.
Fantastic. I'm already loving it. First 5 minutes diving straight to what would really matter to a founder. Eklavya, question to you. What's your perspective on this? Building Record Club, how do you see this?
I think I like to carry from Dhruval's point, right? Founders market fit. So you'll see like, Uber, WhatsApp were born after the 2008 crisis. So best of the companies are formed in challenging times. And this is the true strength of the right founders, right team, right? Other than, because that is what, especially in early to or mid-stage growth companies, right? Which determines and makes a company successful or not over a longer term, right? Because have to be very capital efficient all the time, right? Businesses, even if there is vast liquidity available like it was in the last couple of years, people or companies have taken leverage of running a negative contribution margins, etc. That is not sustainable, right? What it means is you put in $1 and you generate negative money out of it, While you can have overheads, G&A, etc., that's fine, but you can't have negative contribution margin generally as a business, right? So I think that is one thing that people should really focus on. I think and which we do definitely, which we do a lot at our company and the companies that we evaluate. We take that into consideration quite a lot. And I think second very important thing is, I think Amit and Google touched, is measure your ROI, right? You can have various options, especially when spending on CAC. There are a whole bunch of things that one can do, but you should really see what works for your business, whether it's, as Google said, B2B, if it is recurring, non-recurring, B2C. There could be different type of marketing initiatives that work. So know them well, know what's the ROI is rather than just spending on it. But cutting G&A blindly is probably not the best strategy, which a lot of people are doing, or we are hearing. But spending wisely on CAC to maintain proper ROIs for every activity, do that exercise only within your team, which we do quite a lot at Record as well. I think so. And obviously, thirdly, I think there are alternate options of financing available. Leverage them, right? Like founders today are blessed in our views, to have such options which weren't available erstwhile to the companies. So definitely know about them, learn about them, and leverage them to make your business sustainable and growing, and weather any downturns that could be there in the market going forward.
We will come back to you on that. Would love to share, love to understand on behalf of the founders, what are you building and how is it an option, a new asset class that you're building to help founders. But before that, I would like to understand from Madhav. Madhav, you work with thousands of startups in NASSCOM, and what's your take on this? What do you think?
So thank you for this. So I'll just add up on what Amit, Dhruvel, and Eklavya said with an example. There was a startup, I believe 8 months ago. We have this Investor Startup Connect program that we normally run every year throughout the year. So the startup pitched in, and the investor said no, declined to invest in that, said you're not fundable. Okay, so what the startup did was that, okay, why I'm not fundable? Why? What is it that would make me fundable? What is it that would get me that investment? So they went back to the blackboard. Yes, their sales team still went ahead. They were still generating the revenue, but that fundability kind of thing. So they worked on that. So they realized that even before going to an investor to dilute their equity and get the money, they have an option called debt financing. So they went for that. And the founder, of course, collateral is something that, giving collateral is something that people are jittery about. But as Amit said, that you have to be focused and focus with that one thing that you believe in. So this founder believed in that and put the collateral, took a debt, made his startup fundable. And 7 months down the line, we realized this person goes back to the investor and said, here I am. Here I'm efficient in terms of capital. My team is stronger. I've just managed optimize my entire team. So better salespeople, better revenue margins. So this is how we have worked. And of course, now what we know of is they're getting funded. So now the lesson that can be learned from this example is that a no is always not the last thing. So need to work on themselves, their own product and own proposition, I would say, and then go back. This is a cycle. So sometimes you get the funding, you will not get the funding. Similarly, there are startups who say that, okay, we will not go to the investor till the time we think that our product is good enough. So they waited, let's give ourselves 7 months, 8 months or a year. And after that we'll go. So they worked hard for a year and now they are starting to get connected to investors. So there are ways people can mitigate. Yes, of course, I agree with Amit, Eklavya, and Dhruvel that unnecessarily cutting down on G&A and other measures, drastic measures should not be taken. Be focused, simplify the proposition, articulate it in such a way it is very simple for an investor to understand, and then of course bringing up that trust level within that investor community. Okay, yes, you are fundable. So that's something the startups can do, and we do see that trend. These startups that we have at NASSCOM, which are accelerated at NASSCOM, more than 8,000 startups. So we see that trend in the startups. They have more and more of them are understanding this, that, okay, they're not be always a VC as a savior, always a PE fund who comes and invests. We have to be there, because when they come, we put our best foot forward. So we do see that trend as well.
Perfect. Thank you, Madhav. Over to my next question for you, Amit. What do you think? What kind of startups are likely to get more affected? Early stage or growth stage startups? And how can you actually answered? How can they cope with lean months? But um, what has been really like? How are they coping up with the reset, the impact on valuation across stages?
So early stage, the valuations were not out of whack, right? They were perhaps a little aggressive, but they were still okay. So I don't think if anything is going to impact the valuations or the pace of investments in the early stage. If I were to look at, there were three things that were the aberrations of the last wave, right? The last bull run, you had pretty much everybody getting into the startup bandwagon, right? Everybody wanted to be an entrepreneur. You saw so many companies getting set up. So that was one trend that was very, very visible, and you had plenty of corporate professionals also willing to join startups who were more than willing to jump ship from a corporate life to a startup world. So that was the first thing. The second thing was that you could see companies raising one round after the other within every 6 months, right? So you had frequency of rounds really going up. Within over 6 to 9 months, you had a new round, and the new round was almost like 3-4x of the previous round as well. So that kind of playbook, I think, is where the expectation got set over the last decade. I think the first trend of more entrepreneurs is inevitable. I think that is a trend that is likely to continue. There are plenty of problems to be solved. There are plenty of bright people who are looking to solve those problems, who are not satisfied working in a corporate setup anymore. So that trend will continue to grow, is my view. But the other two, which was about the frequency of rounds in terms of within 6 to 9 months, you're raising another one, and that the pricing of that round is 2-3 times higher than the previous one. I think that was maybe excesses of the past. It'll go back to the traditional meme of how the traditional VCs had been saying, which is fund for at least a 24-month runway, 18 to 24-month runway, build enough market traction, build enough validation that the risks have gone down, where the pricing increase or the valuation increase is in proportion to the risk going down, right? So you'll start seeing the traditional VC model come back. And there's plenty of VC money available. So the topic might have been it's a funding winter. I don't think that is the case. There is more than $180 billion that has been raised. So the money is there. The VCs, the traditional guys who are used to working in a certain fashion, wanting to see market traction, validation, progress, the kind of metrics or the diligence they would do, I think that will come back to its normal, back to its mean way of doing business. The crossover guys, the hedge funds, the corporate VCs, HNIs who had jumped in to really add momentum to this in the last bull run, maybe that's the first one which will see the issue. So the growth stage company, which, as Dhruval said, 20 million in revenue, $1 billion valuations, those guys will struggle, right? So justifying those kind of revenue multiples, they'll have to be 3 times that size or 4 times that size to even just justify the last round valuation. And if you start cutting too much, growth will go away. If there's no growth, there is no future. So you'll not be attractive enough as an asset for a new investor to come in. So it's a tough thing for people who have raised money at high valuations. The good thing is the excesses of the past has made sure that a lot of these companies have raised a lot of money, right? So they have raised perhaps hundreds of millions of dollars. So they do have the runway to figure out a better model. And these entrepreneurs are really smart people, so they know as to where the winds have changed and what they need to do to come out successful from this entire thing. Companies who are not so lucky who to have raised money in the last bull run, they've not raised in the last 6 odd months, they will have a tougher thing on their hand. But I think the effects of valuation will be more pronounced in the growth stage, especially because the crossover funds, the hedge funds, the HNIs who are jumping on to just the momentum part, they would take a pause and perhaps reassess. And we are seeing quite a few of them now move from their earlier Series D, Series E investments to move to a more seed and a Series A investments, right? So the early stage companies will continue to get to get a hear from the VCs. They will certainly, good ones will be able to raise more money. Just that the time to raise money may take maybe 4 meetings or 5 meetings, or rather than earlier case where one meeting with the founding team and the VCs were expected to cut a check. So the time to close the round may take longer, but there's plenty of money for the early stage companies.
I think there's a
Thank you.
question. Should we take these questions also right now? Because there's one which is linked to what Amit is talking about. Should I go ahead?
Sure.
Sure.
Yes, please.
Somebody has asked whether such crazy valuation multiples, would they come back? Let's say right now it's going to the correction stage, and then would they come back also at some point? I feel that markets are going to always go into cycles. So I also have a strong feeling that while it is going in the corrective direction, and it will stay like that for next at least 12 months, maybe roughly 36 months, or like just giving a range. But beyond 3 years, you never know. There could be newer kinds of excitement in the market, right? And then markets are generally designed to, and humans are generally designed to follow more excitement. So I'm sure somebody will find some hack to kind of create another level of another wave of, and again, I don't know what multiples it would go to, but definitely there will be a bull run again. Even in private markets, there will be a lot of, and as Amit said, there's already a lot of capital still undeployed. There's, especially for markets like India, more and more capital is going to get deployed. There are still so many funds, global ones, which have not ever invested in India. All of them eventually are going to still come to India. They will also get their experience. They'll probably burn their fingers as well, again, by making the same mistakes by themselves. Hopefully there will be newer and newer entrepreneurs. Right, so they will also kind of try newer models of raising money, newer business models. Could be newer risky markets, could be risky hypotheses which people get excited about, and then the money starts to flow there. So I think, long story short, I think while it is getting corrected, there is very high likelihood that the market will again go and peak at some point. And from what I've heard from others and more senior folks than myself in the ecosystem, is that earlier these cycles used to be roughly like 10 years apart. Like lately, in last 15 years, these cycles happen every 5-6 years. And I think it is because of the more information flow, more and more connected world, right? And there are a lot of macroeconomic and globalization factors. So I am a strong believer of that the cycles may be actually faster than longer, and how they used to be earlier.
Just to add to that, I think the impact of technology on the global GDP is going to only increase. Right? Yeah. So if you are a tech if you are a tech business building in the technology world, your contribution towards the global economy is only going to be increasing, and hence, if there is a bull run, you will have a higher chance of participating in that, being in the tech sector. But whether the winners of the last decade will be the winners of this one, unlikely. I think you will see a huge number of new companies coming and upending the entire ecosystem. So if I were to say, because in tech, what is the common thing is always about creative destruction. So some new guy is going to come up and create a new paradigm in terms of how business has to be done, or a new technology will come which will usurp the current way of doing stuff. It could be AI, it could be robotics, it could be any other thing that improves productivity or other stuff around that. So I think the winners of this decade may be very different than the winners of the last one. And as early stage companies, you need to be not just focused on emulating the next big thing or the big guy from China. You'll be building a similar company to what is succeeding in the US. I think thinking originally and thinking about solving the problems that India faces will also offer you plenty of stuff to do. Because as you look at the macro factors that Dhruval was pointing about, one of the macro factors is about deglobalization. And more countries are going to be looking at making their resilience in terms of supply chains more inwards. They would want their suppliers to be more in their own geos and close enough, rather than having to depend on single source of supply from various other places. So there are going to be macroeconomic factors. Technology is going to be influencing a lot more of the global GDP, and hence there is no better time than today for entrepreneurs looking to build something in the tech world. The rails are there, the payment systems are there, the logistics systems are there, the customer awareness and comfort around digital is there. Technology touches, I think everybody's, every human on the planet is touched by technology. Our daily lives of every human on the planet is touched by tech. So the market is there for people to build some attractive solutions, and there's no better time than today to do so.
Fantastic, thank you. And while you were saying the sun just came upon me, so positive momentum here. Eklavya, my question to you: companies with predictable recurring revenues have alternate financing options, not known to many, but this alternative financing solution converts customer recurring revenue up to upfront into upfront capital today. So, how do you think these alternate financing opportunities can help companies that at the moment solely rely on VC funding?
Sure. So I think, as I was mentioning, right, like founders today, I think are living in a relatively more privileged world. Amit was saying before that they have multiple options. Right? It's not only equity dilution that they need to depend on to raise capital. Obviously, equity has its own stature. One of the most important ways to get you started, right, before you start generating some predictable revenues. But what we and some other alternative options have created in different forms and shapes, right, to the founders today is that leverage your revenue, right, like to fuel your growth, which helps you in 3-4 very, very important things, right, like, and specifically active in times like today. Say you're not happy with the valuations you're getting, right? Like, let's face the truth, founders would always feel that, oh, I should be valued more, but maybe investors are just leveraging the world today, to downplay. A lot of founders will feel that, right? So you typically, people have gotten amazed by the fact that how quickly the cycles return. Like in COVID, we saw there were talks about the 2 years markets are gone. Within 6 months, because of global liquidity, everything was banned. So what I was trying to say was, leverage your revenue to focus on your growth. Maybe you don't need to dilute now, so you can delay your dilution, to a few for the point in time when the market cycles are back and you are ready to dilute. Or even if you're diluting as a good company, right? Like right now, you can always complement this alternative solution with equity. So if you're diluting $100 today, just as an example, you can dilute $90 through equity and $10 through these alternative financing platforms. You still save 10% of dilution, right? And if you aggregately keep on doing that over the next 5-6 rounds over your life cycle, you save at least cumulatively 12-13% of your shareholding. And if you become a unicorn, by then it's like we're talking about $30 million of shareholder value that you save, right? Like, so be very particular about it, be aware about how these things work. Like we at Record Club really want to, build that ecosystem where companies leverage companies with predictable recurring revenue, and we start working with companies that very young, but the recurring is important. I think that really defines, any revenue versus, what you're building, and the tech world is truly recurring. I think that's what the focus has been for us. So delay dilution, don't be worried, right? And dilute less when you want to go for your equity round. And all of this only by leveraging your customers, as you said, right? Like, so up to 12 months of your future recurring revenue that you were supposed to receive from your customers, we facilitate that through the tech play that we have, to get the capital upfront, and that too within 3-4 days, right? Like, so you save time, right? Those are the two most important or the two most precious things that a founder would have, right? Like equity and time. So we simply, we want to put founders and companies to focus on that, and we take care of the two most important pain points.
And I think this is also the answer to somebody else's question. So I want to make sure that they get addressed. I think somebody has asked the question that if Loginext hadn't raised money, how would it have scaled? And is it required for any other SaaS or any other company, or especially supply chain tech companies, what they're talking about, to be bootstrapped? I think this is the in today's world, as Eklavya said, there are tons of options available. And one thing just to add to what Eklavya said, right? What I can tell as a founder is that every founder who has not raised money, they think that raising money is the answer to their question. And every founder who has raised money, they know that money doesn't solve problems. And this is like one I think concept which will always stay forever. I think it's never gonna get old, and everybody will have the same feeling on both different sides of the table in different situations. So long story short, the answer to that question is that capital doesn't really make you scale overnight. It actually doesn't solve a lot of your problems also. But at the same time, you need capital, obviously, to kind of accelerate some of your activities. And especially if you are building a supply chain tech company or a SaaS company, you do have recurring revenue, right? And just focus on two key metrics, right? Recurring revenue, growth, and gross margin. If you have these two strong metrics, just these two, nothing else, I strongly believe that companies like Recur or any other instruments can really help you get sufficiently funded to go to the next level. Right. And I think that's what the strategy founders should take who do not want to or are not able to go the traditional VC equity route. And there's, while it looks very fancy from outside, there's nothing really that happens inside which really is solved by that a lot of capital. In fact, it attracts more problem than raising the right amount of capital. For SaaS and supply chain tech companies, you don't anyways need a lot of capital. They're capital efficient businesses. So even if you raise little, some money, it should allow you to kind of maintain your growth cycles and take it to the next level. And then you can figure out the next problem when you get there, after a year, 2 years, or 3 years. So that's what my recommendation would be.
Great tip. Amit, we were chatting before the session started. What best, like from a founder's perspective, what is best we could bring out from this session? And I remember you were sharing your thought on what kind of capital would be more expensive for a founder between debt, equity. So would want to, could you please repeat it for the founders here who've joined us?
So the business needs cash to grow, right? So that could come either as equity or it could come as debt. Early stage companies, especially tech companies, do not have any collateral to offer, right? Because they don't have really those plant and machinery or land or anything to give out as collaterals to banks. So the debt option is pretty much ruled out of the window for them. So that's where everybody just goes with equity. The question with equity is there's no collateral. So a lot of people may just think it as easy money, right? I'll try it, it works, great. Otherwise, great experience, I'll move on to the next thing, right? So some founders may make that mistake or that kind of thinking. Debt is not so easy because the bank is going to come after you in case of a default. You are committing to certain things. If you do not meet that thing, then yes, the bank will come after you. Equity doesn't have that. So I think the question really is about the cost of debt versus the cost of equity. The cost of debt is more in terms of the interest cost as well as the collateral and the risk of having to cough up that money in case the investment goes south. The cost of equity is okay, zero in the beginning, because if it works, great. If it doesn't work, you move on to the next thing. But in case it works, then the profit sharing that you'll end up doing, the value creation that gets made out over the course of the business, you would have given a fair percentage of that to your equity partner. He may have taken the risk, but he'll also take disproportionate share of the reward as well as the company value grows. So equity is always a more expensive option compared to debt. Debt may, that, okay, this is the outer limit of what the cost of this for me is, which is a certain interest rate. In equity, the payout could be a lot more, and hence the cost of equity is far higher. So as a company, as you look at it, debt and equity both are good. The question is as to what is right for your business at the right point in time. A combination of debt and equity is the ideal one, because all big businesses are built with leverage, right? Nobody continues to just raise equity, because it's the most expensive form of raising capital. The leverage model gives you the best economics, because that economics has to be shared between a lesser number of equity participants, the shareholders. The broader your shareholder base, the lesser it is for everybody in terms of value that is created. So the founder should be looking at debt and equity is essential to provide the cash for the business to grow, right? The combination of it is something that they should be prudent about as they continue their growth journey.
Thank you. Next question to you, Madhav. Recur Club, our team was super excited to understand our partnership with NASSCOM and the whole vision behind helping the founder ecosystem, right? And NASSCOM has always led it from the front. So what are the benefits does NASSCOM provide to startup founders? We've heard what is the Investor Connect program like? It's also the question from one of the audience here.
Okay, so we at NASSCOM have a program called Nivesh. So this is we run this on a half-yearly basis. So wherein we bring in the investors, give one investor an exclusive time slot, and according to the requirements of investment, we select group of startups to present to them. And in that one, we carry this out over a week. So every investor gets at least 2 hours exclusive slot. We have 10 startups coming in, pitching in there. So around 20 odd investors coming in, and we have so many startups coming in, pitching in there. So this is one example wherein that's a 1 week program that we run. And another program is where we do on a continuous basis. So even today, we have a program going on in our office premises today. So there are a group of investors there, and startups are interacting with them. So with the founders, is just not the investment investor connect that we do. We also provide them with mentor connect also. So at times they may not be, the startups may not be ready for that kind of investment that they think they are ready. So we get them the mentors also, people in the industry, people who have done it, people who have raised funds earlier, and people who understand this entire process. So we also get them connected to them, and then they mentor them. We accelerate tech startups. So technology is another area that we help them with, and of course, to access to the market. So for a tech startup, we enable the entire ecosystem for them and provide them. And at times, we also curate some programs for particular startups who show some promise based on certain criteria. And then we have a deep tech club, wherein getting into deep tech club is in itself a big thing, because rules are very stringent in terms of the value proposition the startup brings. And that's where a lot of investors come in and interact with our deep tech club. And we say, if you get into deep tech club, the chances of you getting funded by investors goes up really high. So these are some programs that we do from time to time. And as and when we see that there is an opportunity to do more for startups, not just in terms of connecting them to investors, but other areas also, we also carry all those programs out.
So sorry for doing a mapping comments to questions job here on this show, but as this is also
Thanks, Dhruvil.
and I think somebody asked that what is the, how would somebody raise money, or what would be the advice for founders who are building platform where there are pre-revenue? I think, Madhav gave a great example that, there are platforms like NASSCOM, which enables such pre-revenue founders also to kind of go and showcase their pedigree, their idea, whatever they have built so far, if they have non-revenue traction, what that really means. And there are a lot of angel investors, seed funds, or other investors who believe in the founder and they purely invest based on that. Right. So and I think that has increased a lot lately in last 2 years in Indian ecosystem. There are a lot of similar platforms as well. I think NASSCOM being one of the largest ones. So please, anybody has pre-revenue, you need more of believers versus mathematical or, spreadsheet based investors. So go and find your believers, and I'm sure there will be one to fund you, to take you to the revenue stage.
Great point, Dhruvil. So that's a great point.
Eklavya, like at Record Club, we have hundreds of companies on the platform, and then we understand, we create insights. Share with us, like, how are companies, like in terms of data points, etc. Like, how are companies responding to the situation? What is it like in terms of, give us some insights on some data, like with data of this knowledge of data of these companies, please.
No, sure. Give me a moment. Actually, we have something. Just give me a second. So basically, as we were mentioning, right, like typically what we've seen as trend is people cutting down on their G&A and CAC idly, right, like because of all the noise. And we have evaluated, on our platform, or actively working with more than 300 plus companies today. And the trend that we have seen over the last 6 months is, drastic drop down in terms of their CAC, right, like the CAC spend, the G&A spend. and we do this mapping, for our internal and to our portfolio companies as well, so that they know what people are typically doing and spending money on. So you see, CAC as a percentage of revenue in the last 6-9 months has dropped from 20-23% to around 16%. So people have been frugal about where and why they're spending. At least the people that we are working with, which is a substantial portion of SaaS and technology services in AI, cybersecurity, machine learning, and a lot of SaaS companies. That's been the focus. In terms of G&A, as Dhruval was mentioning, and surprisingly, a lot of people have cut down significantly. Don't know whether it's right or wrong, but we have seen that happening because of all the news around. And I think this will continue, at least stabilize from here till the time the slowdown continues. But revenue growth have been, more like constant. So I think it's been more moving towards sustainable revenue growth rather than, marketing injected fueled growth, which may not be sustainable. So I think this is a great point that people are really focusing upon the right cost metrics, to support their organic growth. So we do this a lot, at Reco, and like we are creating something, as we were mentioning. I'll just give you through. This is a very high level snapshot of typical benchmarks and insights that we do for the company, so companies can refer. We've seen, typically for SaaS companies, the runway is more like 12 months as of now, and a lot of them that the LTV to CAC has been more like 6x. So these kinds of things that we do actively for the companies that we work with, so they can have real primary benchmarking of whether they are performing good, bad, ugly as compared to the competitors in their segments and sectors. Similar things we have done for tech services companies, where obviously the gross margins are lower than SaaS, but they are more profitable and in nature typically, and the growth rates are a little lower. But those are more businesses surviving historically erstwhile on traditional services businesses. So I think these are the 2-3 high-level things that we have actually seen happening, and we keep on having detailed discussions, and there are detailed reports available for the portfolio companies, at least the companies that we work with at Reco Cloud, so that they can gain best from it, especially in the current times.
Thank you. Dhruval, there are a lot of people in the audience interested what you're doing with LogiNext. If you are comfortable sharing with this forum, and I know in SaaS Boom events, you've shared some fantastic relevant data points for startup founders, of LogiNext and the companies that you advise, like just broadly share with us, how are you planning this like runway and the strategy? We hear companies are laying off or not hiring senior folks, or downsizing, etc.
So I think so this can be a much longer conversation, but I'll not make it a LogiNext conversation right now, and we anyways don't have much time. But I think overall, I've always run the company for 7 years now with again being very, very capital efficient, right? So everything that you do, every decision that you're taking to acquire customers, your pricing model, your hiring model, your compensation ranges, what kind of churn is acceptable churn, which you can kind of fix, right? So all these decisions have inherent, runway thinking, capital efficiency thought through it. And how it works is basically typically, and one thing that we see that we've done a very good job at is that from day one, we have had a very good business plan. Now, this is not recommended for everybody because not everybody likes to run the company like a tight ship. But if you want to, then having a business plan, which you can keep measuring yourself against, is very, very important. And I remember like one of our very early investors had given that to me as a template, which is basically nothing but a spreadsheet where you are basically having some revenue projections, but also details of that projections in terms of how you really arrived at it. And every single fine-tuned projections in terms of revenue and expenditure at every single level, at every single headcount level, right? How would it grow over the next 24 to 30, 36 months? If you kind of keep monitoring and keep running your company in a very disciplined manner, you most likely don't enter in, hit any runway issues as such. And then you don't have to downsize and things like that. Now, I've also seen that some business models and some founders, right? They both desire, or maybe business models have inherent need to raise a lot of money again and again, which are very CAC centric, or not CAC centric, but high CAC businesses, let me call that, because they're trying to create or disrupt a category significantly, faster. Maybe their investors also have that view of moving very, very fast and taking very large shots and very, very big risks. Those companies raise a lot of debt also. They raise a lot of rounds very frequently. They dilute more as well. And that's when the valuation has to keep going up. Your numbers have to keep going up. Like there's a constant pressure month on month to kind of keep making that happen. That's another way of running the company as well, where there could be chances of failure, right? There are steeper ups and downs in such models where you see layoffs also, on your journey. Nobody likes it. Founders don't like it. Investors don't like it. But that's an unfortunate outcome of the strategy that the company has been following. So it's more of a choice. At Loginext, I think we have taken a more conscious choice because our business model, as I said, is again, right, for even for our customers, are very conservative. Like we serve industries which are globally large, top 5,000 companies of the world, right? They all run in a very profitable, sustainable manner. They also want to have suppliers and SaaS of vendors who are also of a similar nature. So naturally, by spending more time with them, you also start thinking like them. Like, one of the key things is that a lot of times companies and their culture is a reflection of their customers' culture. So that also happens to you. And that's what has happened to Loginext as well, right? Where we have become more, and we have become comfortable with longer sales cycles. So we have kind of cracked how to still have a long sales cycle, but still maintain our growth rates, right? So things like that. Again, I can go for hours on this topic, but just at a very, very high level to be relevant to this topic of the, of the discussion today. I think it's a journey, and happy to talk more over LinkedIn or any other informal platforms if people want to know more about Loginext.
Thank you. And thank you for answering questions on the chat box for us. Amit, I want to understand we've been hearing, I think all of you are echoing one thing, that we're going back to the whole traditional conventional models of tightening it out in the business, focusing on customers with regards to growth. And there is, we hear and we keep reading, is there a bubble? What is your thought actually on, is there a bubble being burst on valuations and on in the startup ecosystem in India, or like let's say India, US, global?
I think people have been talking about a bubble for a while, right? So, but the bubble only kept going up and up and up and becoming bigger. The reset everybody that is talking about is there. There were a couple of times in the past decade where there were some recessionary, rather just some pricking of the bubble kind of a situation. It could have been COVID, it could have been 2012 or 2008 crisis. But the recovery was V-shaped, right? It bounced back strongly, much better. The question that people are still kind of crystal ball gazing is on whether the recovery this time around is going to be a similar V shape or is it going to be an L shape? Because if it's an L shape, then yes, then you have to gird up for a lot longer time of pain. And honestly, for young companies that are just starting out, they do not really have any encumbrances, right? So they can start out small. They don't need to have the same legacy problems. They don't have cultural problems. They don't have valuation problems. They don't have employees feeling that their stock options are underwater. They can just go about building a solid business. So I think recessions bring out the best opportunities. The serious guys will make a killing, and as the markets grow, people have been conscious about the building blocks. If they have been conscious about the fact that businesses are built brick by brick in the right way, if they focus on capital efficiency, they will have the right DNA to really succeed once the market recovers. So bubble or not, I would say the timing from an early stage startups point of view, it won't be better.
Thank you. Eklavya, what do you think about this?
I think I echo the thoughts, so I'll not repeat as I covered, but I think this rightly put. I totally agree. I think there are some more questions on the chat box we can take quickly before we end.
So we've been taking questions, and Dhruval has also been answering. There is this another question from I think a group which is from NASCOM cohort about how to connect with you guys to understand and to discuss investor opportunities. Are you open to understand opportunities for pre-revenue stage startups?
That's a question to me. Yes, absolutely. This is what we do day in, day out. We get paid for this job, right? So we are more than happy to meet with interesting companies trying to solve interesting problems. I think if there are deep tech companies and AI companies that are there, given that this is handled by NASSCOM, we'll be more than happy to look at that, because we certainly believe that the impact of AI is now going to be unleashed onto the traditional businesses. Up until now, AI has been used more by big tech companies and for consumer related applications. But I think the move to a cloud and the digital transformation of traditional enterprises, the AI will impact some of those industries quite significantly. And we believe that that's a very interesting area for us to focus on and invest more in. And I know that there are plenty of NASSCOM companies from the AI sector that could be here. We will be more than happy to talk to them.
Fantastic. Madhav, any last thoughts, comments for the founders in the
So
audience?
founders to the, there's a famous quote by Winston Churchill. He says, if you're going through hell, just go through with it. Because at some point of time, you'll come out to the light and you'll see that heaven. So to the startup founders, I would say, you started your journey with some conviction, some commitment, and please see to it through a logical end. I wouldn't say that just because the investment is not coming, things are not happening, don't lose hope. There are platforms, we are there. NASSCOM is there, investors like Amit, and platforms like Eklavya's platform, Bricker Club and all. We are there. We are there in the ecosystem. So you're not alone. We are there for you. Call us. We are just a call away, an email away. We are there to help you.
Wonderful. Dhruvil, last comments.
I'll take my last
Inclusive
comment also
advice.
by answering I'll also take my last comment by answering a question. I think, and that's also kind of more punchy, right? So growth versus profitability. That's always a question, right? What do you chase first? In early stages, growth is more important than profitability. I know there are a lot of people, will give you more softer answer, but I would like to, close this session by saying that in your early days, chase growth more than profitability. And when we say profitability, the net profitability, of course, don't go into a negative unit economic model. It's very difficult to come out of it. That means, again, maintain positive contribution margin or gross margin, as we call it, but don't optimize for net profitability. Right? Of course, you can't burn too much money because you have to also take care of runway, but don't optimize for it. Always optimize for growth in early days. And especially most private investors, at least the ones that I have come across in my experience, all of them, they reward higher growth more than higher profitability in early days. So I think maybe that's something that everybody can take away from my conversation.
Thank you. Well, that's all what we have got for you today. Thank you for joining us. We really appreciate you signing in and hope you learned a lot from these phenomenal VC entrepreneur, fantastic, stellar panel. Before we sign off, I would like you to understand more and sign up on the NASSCOM program and Bricker Club in case you would like to reach out to us via email if you're interested or you want to know more. We'll be happy to answer. We missed out on 1 or 2 questions, I think, because there were so many. So we'll try and answer that post the session. Thank you again for joining us. Thank you, everyone.
Thank you.
Thank you, everyone. Thanks for having
Good
me.
evening, gentlemen.
Thanks, everyone.
Good evening.